Good afternoon, traders and investors. Will back here with another one. Hope everybody had a beautiful weekend. So we're going to do another video in the series of the top 5 options plays for the upcoming week. Now, these top 5 options plays will all be options selling plays, more specifically, selling puts. On the channel here, we do the put wheel strategy, which entails writing puts at designated strike prices to gain all of that juicy premium in our pockets. We do these puts on a weekly or bi-weekly basis, meaning we're only writing 1 or 2 weeks out at the most. That is just because the weekly options represent the best ROI on an annualized basis to be writing puts for. So we're going to go over our top 5 plays from last week and see how those did, and also give you guys 5 new plays that I will be looking at for the upcoming week to generate some juicy premium. Now, just a little bit of a preface, guys, before the video. So in this upcoming week and the next upcoming weeks as a whole, I am potentially expecting a little bit of a market pullback. Now, on my daily recap videos, we've been covering this for quite some time, how a lot of the markets right now are in overbought conditions. Big tech is also in overbought conditions, and we could potentially be expecting a little bit of weekly consolidation here as the market enters a bit of a lull period. Earnings are mostly all but through. We have no more CPI reports for another month at least, and we don't have another Federal Reserve meeting from Jerome Powell until March the 20th. So this whole period between now and March the 20th should be a little bit of a lull period, meaning there's just not that much news, guys, that can carry the markets up with more bullish momentum. So could be a very decent time for a little bit of sideways or potentially lightly down consolidation, and I am potentially expecting some daily downtrends. So the reason I'm saying this, guys, is that this week and the next couple of weeks going forward, we need to be a little bit more cautious on the strike prices that we are going to choose. So no chasing stocks to the upside. We're really going to be focusing on stocks that are at very decent large support levels and on stocks that have potentially been kept significantly down as opposed to others that have ran. Usually when the stock market does take a little bit of a downturn, the stocks that have already been down for a long period of time will tend to drop less than the ones that are right up to new all-time highs or previous areas of resistance. So those are the ones that we're going to be focusing on for the next coming weeks. That way, on the other end of this, if ever we do get assigned some positions, they should be very good to run after the markets have consolidated and are into recovery mode. So all that being said, guys, let's go over a little bit of strategy rules before we do this. Now, we run the put wheel strategy, which is a very easy strategy, guys. If you're a beginner, intermediate, or expert investor, very, very easy and very low risk strategy to maintain positions in. But there are a couple of rules that I do want to go over. And if you haven't seen my video where I break down the full guide as of how I run this strategy in detail, I'll link it up above in the right hand corner right now of the video, and I'll also leave it down in the video description. So number 1, let's go over some rules. So here are the rules for the put wheel, right? We need to be writing puts on solid companies. Please, please, please never write puts on companies you do not want to own. It is rule number 1. It's just because if ever you get assigned a stock that you don't really want to own, that you don't know too much about, managing the position if you are assigned is going to be a little bit cumbersome and can take a toll on your mental ability to manage the position without emotions, right? So that is what we want to focus on. So always write puts on companies that you do not mind owning. It just makes everything a lot easier in terms of the mental management of the position thereafter. Number 2, we want to be writing on red or flat days. This just increases our probability of our puts expiring worthless on the Friday. So if on a Monday or a Tuesday the stock opens red, there's only a certain amount of move that stock can do in a given week. That is what Wall Street calls the expected move. So we're looking to write below the expected move. Let's say a stock's expected move is about 5% on the week. Well, if on Monday it opens negative 3%, it just gives us extra cushion to be writing below that expected move, right? So that is going to allow us to have higher probabilities for these trades. Never really want to be writing puts when the stock is on an up day. Always either if it's flat or on a red day. Number 3, all the stocks that we want to be looking for need to be in monthly uptrends or at least long-term ranges. So a good example of your long-term monthly uptrend could be something like your S&P 500. And something that's in a relative range for a while can be a company like, let's say, OXY Petroleum, right? Occidental Petroleum, which has been in a very beautiful range for the past pretty much year and a half at this point. So those are the 2 styles of stocks that I'm looking for here. Number 4 is going to be no earnings this week. Now, you guys may have seen me play earnings on my daily recap channel, whereby I do my own trading account. But every time I play earnings, I'm playing them extremely conservative. But if you're not familiar with the strategy and you're not that familiar with options as a whole, I do not recommend ever writing plays on companies that have earnings this week. That it can be extremely volatile, and the last thing that you want is writing a put at a level that you deem to be good support, and then it just blasts through there. Even though the company may have had good earnings, you guys know how this can go. A company can post a double beat in EPS, beat in revenue, but still somehow go down 8, 9, 10% off of bad guidance or something like that. So you just want to avoid those scenarios. Just make your trading really easy. Now, number 5 is going to be, we want to be writing all of these contracts at large areas of support, or at least a breakout retest pattern. So long-term support area is exactly what I was showing you on a company like OXY, where there's a massive support area down here around $56 that's held up for quite some time. The breakout retest is a very simple trade. Just take Autodesk, for example, right? You have a nice, beautiful range of accumulation here, and then you get a weekly breakout, retest of the top end of the range, and then on to higher levels. So this retest area is also a very high probability trade. Now, the next rule is we want to be writing 0.5 to 1% weekly premium. Now, this is just to say, if a stock is trading at $100, you want to be getting on the puts that you're writing. Let's say you want to write the 95, 96 strike when the stock's at 100. You need to be finding at least 0.5 to 1% of weekly premium on that contract per week. Quick math is if you're writing something at, let's say, 90 cents, or if the stock's trading at $90, you want to be getting between 45 cents and 90 cents as a whole. That would be 0.5% to 1%. This, guys, this is somewhat of an art, right? This is the range that I found to be the most consistently profitable of them all without taking major risk, meaning that 9 out of 10 contracts that you will write will most likely end up worthless if you're writing always within these range. If you go too high in the premium, your risk of assignment becomes greater. So just keep that in mind. This is pretty much my sweet spot to where you can still make a decent amount of money from writing contracts, but you have a very low risk of assignment. Now, before last rule, we're going to be writing at or lower than the expected move. If you don't know what an expected move of a stock is in a given week, you can go to this free website. It's not sponsored by me or anything. It's called optionsai.com, and they have a free tool that allows you to see the expected move on a given stock in any week. Here you can see Tesla, the most recent close at about $200 on Friday, and the expected move up and down is about 4%, and here they give you the actual levels. So we always want to be writing lower than the expected move, which even betters our probabilities of that contract ending worthless on the week and ending up with all of that juicy premium in our pockets. This is the same strategy, guys, that I've used on the channel that I've been showcasing over the past year, ever since I started my channel. And last year was a very good year. We ended with 75% year-to-date returns in 2023. Very good year, almost 2x beat the S&P 500 and the NASDAQ while doing that. And the last rule, guys, is we want to set a take profit at 90% of the contract value. The beautiful thing about this strategy is you only really need to put in about 10-15 minutes worth of work on a Monday or Tuesday morning to find these options plays and to write your puts, and thereafter it's set it and forget it. You just wait for the time decay to make that contract value worthless over the course of the week. Now, the reason we set a take profit at 90% of the contract is, let's say you write the options on a Monday. If for some reason by Tuesday or Wednesday morning, the contract is almost worthless and you're not at your computer, you want to have an automatic take profit set on that so that you can potentially go and write another contract of a different stock that you've been looking at. This is just to keep the management of the position very easy. So with all those rules being said, guys, let's go over the last week's plays, and we're going to do these relatively quickly. So last week's plays were Palantir. So Palantir, we were looking for the 22 all the way down to 21 contract. Unfortunately, guys, this one was a no-go. The stock never came down low enough for us to get this one. The reason we like this one is because it's currently breaking out into this previous beautiful range of whack in 2021, and the lower bound of this range was 2150-ish. So this is also the previous 52-week high. So this is the classic breakout retest of an area while maintaining bullish momentum. So we were targeting the lower end of this area. The unfortunate part, guys, is it just never got low enough. You can see even on Tuesday, it only got as low as about 2348. We were looking for the anything below 22 pretty much, and the premium just wasn't there, guys. So unfortunately, I did not take this trade either. There just wasn't enough premium on the $22 contracts. The idea was good, and I will be keeping this one on the back burner for the next upcoming weeks. Same strategy applies. If ever it starts trending down into our area, We want to be targeting $22 down to $21. I would be surprised if we're going to get that this week, so I didn't leave it on the list for this week, but it is definitely one to keep on the back burner of a watch list for these plays. Now, second play we were looking at was Pepsi, and Pepsi, largely the same, unfortunately, just did not come down early on enough in the week to write the 165. So we were writing the 165s. 165 was a beautiful area of support for Pepsi since pretty much the month of November at this point. You can see how hard it is for the bears to really get through this level. Pepsi reported earnings, and we went through the earnings on the channel as well. And the earnings, although fairly decent, did show that Pepsi was struggling with price increases. However, it is a legacy brand company. Their balance sheet is very, very solid as a matter of fact as well. And that consumer discretionary spending towards this brand should be coming back in the later part of 2024, which is why I have no problem buying this company when it is so low. As you can see, this has been a very big area of support over the past couple of years. Obviously, there are some spikes down into the 156 range, but even that in terms of max drawdown is not so far from the price that we're writing, guys. That would only be drawdown of about 5% on a company like Pepsi and Coca-Cola. Really not anything stress-inducing at all. But unfortunately, same thing happened on Monday. You can see this big green candle went all the way up here to about 170, and even on Tuesday at the lowest, it was only about 167.5 for a very short amount of time. Pepsi, you need Pepsi to get really close to strike prices, guys, because there's not a lot of volatility in the stock, unfortunately. As you can see, even with the stock trading at 166.32 right now at the end of Friday, look at the options for this upcoming Friday. The 165s aren't even paying 0.5% yet. You would need to see about 82 cents on this bid right here. And you can see even with the stock so low, even on Friday, for this upcoming Friday, not enough premium on the 165. So that was the case all week. There just wasn't enough premium on the 165s to make that worth my while. The idea for the trade was good, just unfortunately too low volatility, however. But hopefully it just goes to show the type of stocks that I'm looking for and the type of chart structures that I'm looking for as well. The third stock here that we were looking for was Tesla. And I did take this one on my own. You can see that on the market recaps video that I did last Thursday and Friday where we closed the position. So we were looking for Tesla anywhere below 180. And on Tuesday, this actually got opened for us. As on Tuesday, the stock was down in the mid 180 range, 184, 83-ish, and you could have found below the 180s. We're talking about 177.50s. We're paying roughly 0.5%, and even the 180s, if you wanted to go a bit more aggressive, guys, we're paying up to $1.50, so closer to our 1% rule. So Tesla was a very beautiful trade. If you would have taken anything under 180 for the week, you would have ended up worthless, pocketing all that premium. I still like Tesla, still one that I'm keeping on the back burner. It will not be featured as one of this week's top plays because now it's a bit too high. The implied move for the week is down to about $192, and I really want to get some premium, guys, in the lower 180s if possible. And unfortunately, at this time, as you'll see when I pull up the options chain for Tesla here, guys, there's just not enough premium at the 180s for it to be worth my while just yet. I'm still going to be keeping an eye on it for a drop, but it would need a heavy drop at this point, guys, to get all the way down there. We're talking on Monday and Tuesday. It would need to come down, roughly 8% to really open the door for under 180s. You can see that right here. The 180s just about 23 cents now, so not enough premium, not enough meat on the bone for me to be taking this trade. And I don't want to be writing, guys, as high as the 190s, 187.50s, because if the market as a whole starts coming down, I do believe Tesla can retest some of these lower levels, and that's when I'm going to be going shopping. So once again, play to keep in a watch list for a back burner in the next following weeks if the market does drop off. 180 and below is my sweet spot. So the next one we're going to be looking at is Tesla. So Tesla is going to be, Expedia. So Tesla was one that was successful. We did it last week. Expedia, however, another play that unfortunately, as of Monday on the open, we just started moving higher. So Expedia, we were looking last week. I wanted anything in the 125 region. So here we have a nice, beautiful range of accumulation, break out of the range. Now we're looking to retest the top end of this range, about the midpoint of the 120, so 125, 126. However, on Monday and Tuesday, the stock just continued to move higher. So obviously when the stock moves higher, it means that we cannot write much premium down here in the 125 level. So the idea was good. However, the price just moved away from us. However, I will be looking out for it, guys, on the watch list for this week as well. We're going to present that when it comes. But just to say, this price action as of last week did not open the door for us to be writing the 125 contracts. Unfortunately, another play that we'll have to keep it on the back burner. And the last play here that we were looking for last week was STZ Constellation Brands. Constellation Brands, I really liked it, guys, in this lower area right here, talking about roughly 235. The expected move for last week was about 238 to the downside, but it never really got there. Same thing as the other four companies, guys. You know, on Monday, really had a nice green day. And then on Tuesday, Wednesday, price action was fairly muted, never really getting lower than 243. So unfortunately, Constellation Brands doesn't move that aggressively. So we were not able to find any premium down here in the lower 236, 235 level, although it would be a very juicy area to be writing some premium. Unfortunately, the contracts just didn't open up for us, guys. So last week, in terms of the plays, I mean, in my own account, I did take a bunch of plays, some more aggressive than others. But out of the 5 that I presented on the channel, none of them pretty much, except for Tesla, came to fruition, right? Palantir was a bit too high. The idea was good, but was a bit too high. Wasn't enough premium. Pepsi as well, bit too high. Didn't get the drop on Monday and Tuesday as we wanted to potentially be writing in the 165, 162 area. So that one as well was a no-go. Tesla was the only one that actually did do exactly what we wanted to do Monday and Tuesday. We were able to get some premium down there. But Expedia, as we were just explaining, not enough premium. The stock went up away from our 125 area, and STZ as well just moved away from our potential area that we wanted to be writing in down here in the lower 235s. So unfortunately, out of those 5 plays, guys, only one of them we were actually able to open the trade. But of that trade that we did open, it actually was a very profitable trade. So all of the trade ideas were good. Just sometimes the market doesn't move in the direction we want it to open up those premiums on those contracts. So unfortunately, last week, only 1 out of 5 trades were possible to be made, but the one that was possible to be made did play off very good. So I hope you guys enjoyed that. Now, let's take a look, guys, into some of the earnings plays that we had for last week as well. So we were looking at 2 plays after earnings, bit of the same concept. We were looking for Airbnb below pretty much 140, 135 would have been perfect, but after earnings, Airbnb really rocketing to the upside. And by the time they reported earnings here, you know, pretty much it was Thursday at that point. No chance of getting below 140 on the premium. So that one unfortunately did not play out. But if ever we would have dropped 10% for earnings, I definitely would have gone shopping for Airbnb down there. So that one was a no-go. And then this next one as well, a little bit of a no-go. I actually took Shopify before earnings, but I took them extremely conservative. So before earnings, Shopify was trading roughly $90, guys. I went with the 71s. So very, very far off of the price move. That would have been a 21.5% move to the downside there. So I did get a little bit of a play here on Shopify, but as I recommended, everybody should be doing these plays after earnings. After earnings, they were opened as well. You could have got maybe a 72. I was looking at the 72, $73 area, which is a decent area, guys. It's still roughly previous resistance and roughly current support as well. Obviously not as solid an area as some of the previous support levels that we've been looking at on prior charts, but still nonetheless a decent level for a very good company. And I did enjoy their earnings despite the fact that they did drop. We covered their earnings on the channel last week. So Shopify, another one to keep on the back burner for the next upcoming weeks. If we do revisit these lower $70 areas, I do still believe that's a very juicy spot to be farming some premium into. So those were all of last week's plays. Now let's get into this week's plays. So stock number 1 is going to be Google. Now, Google, one of my favorite big tech stocks, guys. It has one of the lowest valuations out of all big tech currently, which is why I like it. So here's the play on Google. The expected move for Google is about 138.62. Now, from current close on Friday, that's about a 2.25 move to the downside. It also coincides with a very big area, these 2 yellow lines, previous resistance, which is now going to be acting as current support as well, which is why I want to be writing in this area. If Google opens red tomorrow, Tuesday morning, keep in mind it is a short week, so we are going to have to be fairly diligent on tomorrow morning's open. Now, if it does open red over the course of the morning tomorrow, we dip down to the 140, 139s, I'm going to be looking for 138, 137 puts. Now, keep in mind, guys, Google doesn't have that much implied volatility, meaning you have to write fairly close to the strike price. However, it's Google, their valuation is low. It's at a very nice area of support right now. That is why I love playing this stock. I've been playing it a bunch of times, guys, over the past 2 months, and have made a lot of money playing Google recently. So Google, we're going to be looking for roughly the 138s, 137s if we do get that extra dip. If you guys can see right now, where you get that 0.5% rule is only about the 139. So 139's a little bit high because it's over our expected move. We want to be writing below the expected move. So if you get a red day on Tuesday tomorrow, that should be opening up the premium on the 138, 137 contracts. I'll be looking for roughly 75, 80 cents on the bid if possible for Google. So that's the trade on Google that I'll be looking to make. Another company is going to be Apple. So this is second place. So play number one, play number two. Obviously, extremely sexy companies and extremely attractive companies too, right? And you can't really go wrong with buying either one of them. So Apple expected move to the downside for the week from Friday's close is 178.84. That represents downside of roughly 2%. So we want to be writing below the expected move, 178 all the way down to 175. Depending how low Apple opens tomorrow, that will let us know how far down we can write. But anything, guys, 178 down to 175, that is extremely juicy. It's a very big area. It's the previous all-time high resistance area for Apple and has been extremely good support. Now, the downside potential risk, if assigned in the high 170s, is only about down to about the high 160s. So not that much. Even if we were to get assigned, guys, at let's say 178, it's only potential downside of about 5%. So same example that I was giving on Pepsi, right? The downside risk is just not that much. Apple is extremely solid despite the fact that they have a little bit lower revenue guidance for 2024, but there's no major underlying issues with the company. I'm pretty sure everybody loves Apple as a brand, and everybody also is akin to knowing that the stock price is usually fairly resilient. So that's what we're going to be looking for, guys. But as of now, if I show you the Apple options chain, you'll see that those options aren't yet available for the 0.5% rule. So if you take a look at the 177.50s, we want to be seeing at least, guys, at least 85 cents right here, right? So we're not seeing that yet. It's only about 54 cents. So we do need a little bit more of a drop on Apple on Tuesday morning tomorrow. So if Apple opens up in the 180 handle, this should, in theory, open up the 177.50 strike. As I said, I'll be looking for at least 80 to 85 cents on this for it to be worth my while. And obviously, for some reason, Apple opens up extremely negative tomorrow morning. Let's say it opens up minus 2%, goes through our expected move down into the 177s. Well, then we have to go shopping for potentially the 175s. 175s, I'll also be looking for roughly about 85 cents on the bid to trade that contract. So that's trade number two. Trade number three is going to be BABA. Now, if you remember my rules that we said earlier on the channel, right? This needs to be in a monthly uptrend or in a long-term range. Now, if you notice BABA is in neither, but I'll tell you why I like this company. If you didn't see my earnings video where I covered their earnings, guys, this company has absolutely ridiculous fundamentals. We're talking so cheap that is currently one of the best value plays in the entire market. They're still growing earnings extremely fast. They're still growing revenue extremely fast. And that's why I'm making an exception for BABA. That's why I've been playing BABA aggressively. As you can see, EPS expansion through 2026, very good. Revenue expansion through 2026. Their valuation is ridiculously cheap, even though they're growing earnings at a ratio of about 15 to 20% per year and growing revenue over 10%. They only have a PE ratio of 13 on a trailing basis, and on a forward basis, it's about a 10. And they have a free cash flow yield, guys, of about 13, 14%, which is absolutely ridiculous. Usually anything over 5% free cash flow yield is good. These guys are trading at 13, 14. I will make an exception for them. We're trading back to pretty much IPO prices of 2015. And if you guys notice, right, how much more revenue Alibaba is making now as opposed to 2015, 2016, right? They were only making, in terms of revenue, 2015, 16, let's call it an average of $17 billion between those 2 years, 17, 18 billion. And as of recently, they're at $130 billion, right? So almost, 7, 8x the amount of revenue. Stock price is roughly the same. It's just because the Chinese narrative in terms of the trades behind China, because China's economy has been a little bit of a rut lately. Well, this trade has been unfavorable, but the valuation of Alibaba is one of the best in the markets right now. That's why I do like playing this company. And I'm going to be looking for anything under $70. I think Alibaba under $70 is a no-brainer, which is why even though I am assigned 100 shares at 82 already, we've been bringing our average cost down. This is what this chart is right here. all the premium I've been writing so far to bring my cost down from 82, and I'm looking to average down into even more if we get this lower area in the $70 range. So the expected move for BABA is 71.38. 71.38 to the downside is about 3.5%. Now, if BABA opens red tomorrow morning into the 72s, it may open up anything below $70. Anything below $70 for BABA, in my opinion, is a steal. Now, do we have support? We have a little bit of support here, guys, in the mid $60 range, but not much more than that, as you can see this extended downtrend. So I am taking this one myself, but obviously none of this is financial advice or a recommendation. There is potentially some risk involved in making this trade. I am comfortable in taking that risk, but obviously everybody has different tolerance and different preferences. If you want to sit this one out and rather play the stocks that do respect all of my rules, I completely understand. But for those of you who are more in tune with BABA's valuation and why this can potentially be a very successful trade over the next coming months, well, this is the explanation for that one. So on terms of Alibaba, in terms of the options value, let's bring that up right now. So you'll see if we're looking for anything below 70, you'll see that as of now, not enough premium, right? Only 24 cents. We want to see at least 35 cents on the bid. What's respecting the 0.5% rule is the 71s. 71 is a little close to our expected move. So if we do get a little bit of a red day here tomorrow, it may just open the 70s or maybe even the 69s would be even better. I'm going to be looking for one of these two contracts for the 0.5% rule minimum. Now, our before last play that we have for this week is once again going to be Expedia. Expedia, didn't go into it before that much, but the reason I love this place so much, guys, is just the valuation and the fact that they're growing. They had their earnings and you can see this big sell-off of about 17%, but it was not because of anything that the company did. Nothing's bad about the company. It was a surprise news that the CEO was stepping down. Did he step down because he got into some legal troubles or some, media struggles whatsoever? No, not at all. He just stepped down because he felt that he had served his time at the company. He had grown the company a lot and he was just ready to move on to different things. And the stock was not expecting that. So he had a big drop, but you can see earnings were fantastic. And if you want to see a little bit more, we did cover this about 2 weeks ago at this point. You'll see if you go back in my video thumbnails, you'll see one with the Expedia logo and their 17% price decline. We went through their earnings and their earnings were absolutely beautiful. This is one of the best plays in travel and entertainment, in my opinion, right now. Once again, we're going to be targeting the the mid 120 range. Sorry, I can't really draw straight lines apparently. So we're going to be looking for the top end of this range right here, right? So it should be acting as current support. Breakout or retest of this area. You can see this best on the monthly as well, right? Breakout on the monthly, retest of this range. Then we're gonna be ready to go as travel demand is still very, very strong for 2024. So we wanna be looking, guys, anything 130 to 125. The expected move currently is about 131.73. That's about through 2.73% to the downside. So if Expedia does open red on Tuesday morning, tomorrow morning, right? Let's say we open down in the lower 130s, it may just open some contracts below 130, and anything below 130 for this company, in my opinion, is a steal currently. As you can see right now, the 130s don't yet represent 0.5%. For 0.5% of this, you want to see about 65 cents on the bid. And if you don't know how I'm doing this in my head, guys, just look for half of the strike price in cent increments. So half of 130 is about 65. If you want to do the math, if you get 65 cents for the contract on $130 is the strike price, right? That is roughly 0.005, 0.5% for the week. So I'm going to be looking for the 130s, 129s, need to be seeing about 65 cents on the bid. As you can see now, I only get that on the 131s, and the 131s is a bit too close to the expected move. I'd like to be a little bit below that here. 130, 129 is going to be the target area. And lastly, guys, the last one I want to show you is going to be Nike. So Nike, another one, guys, that's been affected by China. Now, Nike does have a longer term uptrend in terms of the stock, but as you can see recently, it's just been this wide monthly tightening range with overall support down here pretty much $95-ish all the way down to about 82, but those little spike downs didn't really last for long. If I pull it up on the weekly, only stayed down here when the market got crushed in October of 2022, and most recently last September when we had the extended sell-off, August, September, and October. You guys remember that? Big sell down in Nike. But as a whole, guys, the level that I'm looking to be respected more often is going to be that $100 mark. So anything below 100 is going to be good at this point. It's been acting as support a bunch of times in the most recent couple of weeks. So I'm going to be looking for $100 and lower. Now, 101.36 is the expected move to the downside for the week. So that does represent downside of about roughly 2.25% at this point. So if we go in the options chain, guys, you'll also see that Nike doesn't have a lot of implied volatility. So you really need the stock to come down, you know, a little bit more here tomorrow morning, maybe in the 102, even 101 area. Let's say Nike goes down 2% tomorrow. It will open up most likely the 199. So as of currently, you'll see not much premium on the 100s or the 99s for Friday. Only about 24 cents. We need to see at least 50 cents on the bid here, guys, for it to be worth our while. So that's what I'm going to be looking for on Nike. 100 to 99 strikes. Need to see about 50 cents on the bid for it to be worth my while. But Nike, a couple of these plays, guys, you know, if the markets do come down, we're looking for stocks that are already relatively a decent amount off their all-time highs, so they can't get that extended drawdown that maybe companies like SMCI or things that have run a ton recently can potentially pull back, right? If I pull up the chart for Meta, do you guys see any areas to be writing puts around support areas at here? No, right? So that's why I'm not choosing these companies that have run a lot, despite the fact that they're really good companies. If you get assigned up here, guys, the risk of drawdown is just too large before we encounter another decent area of technical support. So that's why I'm choosing some of those plays. Even a solid company like Microsoft, right? Microsoft for weekly consolidation to touch a next important area of support is all the way down here at 382, right? If you get assigned up here, that's risk of about 6-7% to the downside. I know it's not that much, but it's just I would like it better if we were already down there, and then I'm targeting this area of support down here, right? So that's how I choose my plays in terms of support and resistance levels. And hopefully this video was educational in showing you guys a bit more how to run the put wheel strategy and how I do my stock selection for that. So that's pretty much everything, but a few notable considerations to save on your watch list, because these stocks are still in very nice ranges of accumulation, and I'll be looking to play these. So I have a watch list, and these are always on the back burner because of where they are. Play number one is going to be Caesars. Don't play Caesars this week. It has earnings on Tuesday, tomorrow. Do not play them. However, in the forthcoming weeks, if we still maintain around this $42, $41, $40 level, I really like this level to be playing puts. It's been an area of support for the past year and a half, pretty much. Not expecting that to break anytime soon. Company's fundamentals are just fine. Just really trading down here after that 2021 peak and into 2022. Just haven't recovered just yet, but has been a significant area of support, you know, in the stock's most recent history in the past 5-6 years. 42 down to $40 level. Love it, just not for this week. Second play, Oxy, OXY Petroleum, same stock that I brought up earlier in the video. If we get closer at $56, $55 levels, I will be play this one again. We did have a nice rally after earnings last week, so we're kind of a bit away from that area, but still one that I keep on my weekly watch list if ever we're close to this area. Another stock in the energy basis, right? In the energy industry is going to be MRO. Now, look at this beautiful area of support right down here. $22, $21 is absolutely perfect. Has been support pretty much since June 2022, so over a year and a half, almost 2 years. If we go back to February of 2022, very juicy area of support, keeping it always on the weekly watch list. I'm not doing it this week. Why? Because they have earnings as well, but is still on my back burner watch list that I want to keep a close eye on in the forthcoming weeks if it opens up some opportunities. Another one is going to be Philip Morris. So Philip Morris, also very good support down here. You know, $90 all the way down to about $86. Whenever we're trading in this region, I'm always looking to play Philip Morris. I pulled up the premiums. The premiums for this week are not that great. So if we get a big drop on Philip Morris Tuesday morning, it may be open for me, $87, $86, 0.5% rule. Very beautiful support as well. So you see, most of these charts look the same, right? Texas Instruments is another one, right? So Texas Instruments, I'm going to be on the watch for this. Implied volatility is not so high, but pretty much I like this. 160 down to the lower bound right here, 148-ish is going to be a very juicy area of support. right? If you just take the red line to this line right here, here are the spike down outlier areas, right? So July 22, October 22, October 23 as well. But normally this stock does maintain the first level of the first line of defense, the 160 area. So Texas Instruments, another one on my back burner list. If we break down here into the mid 150s, I will be potentially looking in the next couple of weeks to play below 150. So just keep that in mind for Texas Instruments. Right. The other one was Pepsi. All you guys, obviously you guys know, 165 down to 162. Love playing this range if the premium does permit. And the last one, guys, is obviously going to be Tesla. Tesla, as I said, need to be waiting a little bit more. So hopefully that all those charts give you a little bit better indication of the plays that I favor over and above other ones. So hopefully that was educational in terms of running down those options plays. Now, if you enjoyed the video, guys, please consider dropping a like. Would really appreciate it. Really helps grow the channel. And as always, if you are a new subscriber, I thank you so much for your appreciation of the channel and engagement. You guys make it all the worthwhile. But if you haven't subscribed yet, consider subscribing to the channel as well. We do these video top 5 options plays pretty much every Sunday or Monday night, whichever the day is before the market opens the next day. We do them for the upcoming week. We do daily market recaps every single Monday to Friday after the close. And as usual, guys, if you have any questions at all on the strategy, technical analysis, anything you want, any stocks you want me to look at specifically, leave them down below in the comments, and I will say what I would do in terms of a play on that, not financial advice, of course. All right, so take care, guys. Thank you very much for watching. I'll see you tomorrow in our daily market recap. Happy trading. Peace.